it's sort of like using a credit card. I like to use that example, right? When you use a credit card, you're collecting the credit card points, right? And you use these, it's a reward system for when you're spending, right? And this is a reward system for investing. Like if you're a passive investor, you should be collecting these capital losses, right? Accumulating them, accumulate them, because you never know what's going to happen in the future. They don't expire. 20 years down the line, you sell a home for a big gain, well, you're going to have to carry forward a bunch of losses that you can use to offset, right? Gains. That's how rich people think. They are developing a shield against capital gains taxes, and everyone can take advantage of that.
Welcome, everybody. Trends with Friends. As always, the Pearl Dog, Hootie and the Blowfish. We've got JC, Baby Blue JC, Cuban Missile Crisis, bringing the charts. And we have a lot to catch up on, JC. But in this era of this leg of this new trend, we will argue later about the bull market, bear market stuff and what we're seeing in the math. But I wanted to bring on a friend of mine and a guest, a founder, twice founder, early advisor to Instacart. I don't know if you boys use Instacart. Do you use Instacart?
Every day.
Really?
Maybe right, 3 times a week.
I used it during the COVID.
You've got a fan. I used it during the COVID. Is that like the Facebook?
The Facebook.
Is it Hoodie or the
I used
Hoodie?
It during the COVID times.
So we have my friend Mo here. Mo will introduce himself, but he was so early at Twitter. Like us, Phil, he created Twitvid, which is as bad a name as stock twits. So we can talk a little about naming things. And then he has now started a company, and he was acquired by Twitter. Supposedly he took a sink into Elon Musk's office and just dropped it on his foot and then resigned. That's not true, but if you say it enough times, it can be true in the world of AI. And then now, is on a hunger strike. He hasn't eaten in 3-4 years. And he rarely makes podcast appearances. He's been busy building this incredible app and company called Frec, which is a direct indexing, do-it-yourself direct indexing product that is launched, doing very well in this era of the degenerate economy where everybody has so many choices and loves to trade and loves to YOLO. This has a lot of something for Phil here, because direct indexing is something that I'm doing a lot of and using Frec.com for. So welcome to the show, Mo. Maybe just give the boys a little bit of a deeper background. And if not, no worries. But Twitvid, the original idea, what excited you about Twitter at the beginning? Because we'll get into direct indexing after. But you're early to trends. So what was it about Twitvid?
Yeah, thank you for having me here today. I'm excited to talk to you and hang out with you all. Twitter was fascinating. Back in 2007, 2008, the idea was very infectious, right? It was about giving everyone an equal voice, right? Like someone can be tweeting out of, like the voice of back in those days, we used to say, the voice of Barack Obama is equally heard as someone who's tweeting out of, a slum somewhere, right? So that was really cool. I mean, it was a movement back then. If you remember, 2007, 2008, it was, people wanted to build on Twitter. There was a thriving developer ecosystem. Like when we launched Twitvid, it was an API. It wasn't an app. It was an API, and it was used by all these third-party Twitter applications, Twitterfon, Ecofon, Tweety, and all these. There were different ways to access Twitter back in those days.
TwitPic.
No, what I'm saying, TwitPic, yeah, that was big. It was the Hudson River, the plane landing that really hit the moment, right? That was our inspiration. It was like, people are sharing photos on Twitter. Why can't people share a video on Twitter? Back then, the iPhone didn't even have a video camera capability. Just let you take photos. It was, it was only until 2008 that the iPhone had video, and we were excited to be on that wave.
And so Twitter comes along. You get acquired. You're working at Twitter. Who was your boss?
I worked for Kayvon Big Four, who was the head of product. And then, like in classic Twitter fashion, there was a lot of reorging happening. So I had
we've reorged. Phil may not be here next week. We do a lot of reorging. And what's the number one thing you learned at a big organization? So you're new to the working world, I think. You come into Twitter, you're acquired by Twitter, you have probably 20 different bosses, 20 different reorgs. Now that you run your own company, which we'll talk about, what's the biggest thing you learned at a big org?
Well, it was very different from the startup world. I had spent, at that point, maybe 9 years building a company, and joining Twitter was like day and night. It was so different. Like you had to work within processes and do these things that seemed like were counterproductive, right? Like write a lot of documents because you're trying to at that point like spread knowledge and you're not trying to move quickly and you're not running out of cash anytime soon. So you're sort of like you're planning a bit further ahead than at a startup. It was a whole different way of working. It was fascinating.
And so you leave. When do you get the investing back? So let's get right into direct indexing, the stuff that JC, Phil, and I. For anybody watching this show, obviously they've opted in. They have money. They aspire to have money. They aspire to have this freedom. So you finally have some financial freedom to drop that sink on Elon Musk, or was it Jack? It doesn't matter. You flipped a lot of people off. I'm kidding. So you leave, you go on your financial freedom. What takes you down this rabbit hole of direct indexing? Because you're a product guy, from Twitvid to working on fleets at Twitter. But you're a product guy at heart. You go down this investing path. What leads you to direct indexing?
As you mentioned in the intro, I was an early advisor to Instacart. So I had done some secondary transactions early on. So I had some money, and I ended up working with a few wealth managers and was quite unhappy with what I was getting. It felt like, I wasn't understanding the products that they were selling me. They were sort of like pushing these products on me. Like, hey, there's this thing called direct indexing. You got to do it now. I'm like, what is this? How does it work? They're like, oh, there's an alpha of whatever X%. I'm like, what does that even mean? And they didn't really know the answers, and I really didn't understand. So it came out of frustration. Out of my experience with working with human money managers who didn't seem like they quite knew exactly the products they were selling. And I was convinced there was value there, but it wasn't clear what the value is and how I can apply it to my own situation. So I went in and I dug into it myself, and I discovered that it's quite valuable, but it's probably delivered in the wrong way, and it's not done in a self-serve way. Like I want to be able to go in and do these things myself.
And so Frec is born, and walk us through what people should know, because I think, Phil's an indexer. I'm now an indexer. I use Frec mostly, but I'm an indexer in my later life. And you're learning so much about who the customer is and what they actually want. And there's this move that, Phil and I talk about, and JC was late to this, the mutual fund boom, where we were paying 3 to 4% to kind of copy trade people's portfolios, right? It was all done under legal disclosure. We were basically betting on some guy's portfolio and paying a lot of fees to have someone come bring coffee to the brokerage, blah, blah, blah. The same stuff that happens today with just less middlemen. And then along comes ETFs, which is a beautiful phenomenon. You'll walk us through that. And now we're at direct indexing. So just walk us through how that works and your discovery and how you built this.
Yeah, it's really fascinating. Can I share some slides? I have a couple of visualizations.
Yeah. Let's take over the slides. And Phil, what direct indexing is, and JC?
I love it.
I'm learning about it. Like, I've got an account with like Ritholtz and them, and they help me out with like, different the losses, like the tax loss harvesting and stuff like that. Like they do that for me, and they do it really well. I don't really understand it, but it's working. Whatever it is that they're doing, is that like how much am I directing?
Yeah, and from my point of view, Howard, what you were saying before about the mutual funds, like we are on this path of becoming more efficient investors. getting rid of the fees, direct indexing with no, indexing with no fees, and now direct indexing seems to be the next phase of taking sort of some aspects of market, structural market inefficiency out of the investing process.
Correct. So Phil, what layman terms is just something that's been built for very rich people because there were costs involved to get your brokerage and to do the trading to make this happen. I think what Mo's going to walk us through is how technology has brought down those costs to make it available to everybody. All right, take it away, Mo.
So direct indexing has really two main objectives. The first one is it's a tax deferral strategy, much like ETFs are a tax deferral strategy, which we'll talk about in a second. And the second thing is a personalization strategy, which is, you may want the S&P 500 minus this stock or minus the sector or plus this other stock, right? We think at Frec at least that the tax advantage of an ETF is sort of like the primary selling point. So we really focus on that, right? And we try to explore that. And one way to truly understand that is to first understand why and how ETFs are tax advantaged in the first place, right? And then relative to mutual funds. And then we will see then how direct indexing is tax advantaged over an ETF, right? So it gives you an even additional tax advantage. So, one thing that folks don't quite realize is that by law, both ETFs and mutual funds must pass down capital gain distributions to their owners. But ETFs happen to, dodge this using a special mechanism. There's a 1969 Nixon era law called for in-kind redemption. So when ETFs have a gain, they don't pass that gain down to the owner of the ETF. Instead, they are able to use in-kind redemptions to trade baskets of appreciated stocks and create or redeem shares of their own ETF through market makers, right? So you'll see on the chart on the right, like a mutual fund will pass down gains to the owner every year signifying with the black dots, whereas an ETF wouldn't. And so I have this cool chart that kind of shows that it's got three sections. On top, the net asset value, right? And then in the middle, the number of shares, and the bottom is the tax paid, right? And with a mutual fund, it's really simple, right? What's going on here is every year, the mutual fund goes up, let's call it 10%, right? And then you get, you get that $10. Let's say it's a $100 mutual fund. It goes up by 10%. So it's at the end of the year, 110. You get passed down the $10 in gains, right? So you pay taxes at the end of the year, right? On the $10. And then the remainder of the $10, the $7 and change, gets reinvested back into the mutual fund. So you get slightly more shares. And so basically every year, what's happening is you're paying your taxes, right? By the end of year 1, 2, 3, 4, by the time it's year 5, you're basically current on your taxes, right? With a mutual fund. That's sort of like the old way of doing things. And then what happened is ETFs came along. And what ETFs allowed you to do is to defer these gains until the very, very end. So now your asset and your NAV is going up. Your number of shares is constant. And at the very end, you pay taxes, but notice how the taxes that you pay at the end are basically the same as the taxes you paid as if you had a mutual fund. With the only difference is that you essentially have not paid those taxes across the years. You've deferred taxes, you pay them at the very, very end, right? And that's sort of like a no-brainer to us all. Like we know this, we understand that because we use ETFs and they've been popularized for this reason, right? And we kind of take them for granted. But really what's happening is you kind of have almost what folks call an interest-free loan from the IRS. Like while your ETF is gaining value, you're not paying any taxes on it until the end, and you're compounding, those unpaid taxes. And Goldman Sachs estimates that the value of these compounded unpaid taxes to you as an investor is a cumulative benefit of about 4.4% over a mutual fund for this certain set of circumstances that they use a scenario for. Now, it gets even better because, no one likes to think about death, but if, the loan is kind of forgiven at death because of the step up in cost basis, right? So if you hold a mutual fund and you're paying your taxes on time every year, and at the end, you pass away and your step up is quite small. So you haven't quite taken advantage of the cost basis step up. Whereas with an ETF, it's basically a forgiven loan, right? So that's a story behind ETFs and mutual funds. Now, where does direct indexing fit into this whole thing, right? And how is it even better than an ETF? Well, first, I'll quickly describe like the mechanism of direct indexing and how it works. Direct indexing is simply taking an ETF that tracks an index like SPY, for example, breaking it up into its individual components, like the stocks that make up the ETF, right? And whenever one of the stocks drops below the price you paid for, its cost basis, it's sold, and another basket of correlated stocks is bought temporarily, right? And then, for 30 days to avoid the wash sale period, and then you kind of come back into the original position. And as you're doing that, you're crystallizing losses, and you're using these losses to offset some other source of capital gains, right, to reduce your tax bill. And this is like this motion of tax loss harvesting is really important, and it's very interesting. So I want to just walk through it in a slightly more detail. Like imagine a single stock. Let's think about just a single stock. Let's call Tesla. You bought $20,000 worth of Tesla at some point, right? It has gone down over by the second year by, call it 30%, right? So $20,000 is now worth $14,000. Now, imagine two scenarios. Like in one scenario, you have not tax loss harvested at all. So your cost basis is still $20,000. That's on the left-hand side, right? On the right-hand side, let's say you have tax loss harvested the stock, right? So you sold Tesla and you bought a correlated set of stocks like GM, Ford, NIO, or something like that. Like some covariance matrix can tell you exactly what the right set of stocks to buy that are going to be closely tracking Tesla, right? And so what happens in the tax loss harvesting scenario is you've dropped your cost basis down to $14,000 because you've crystallized a loss of $6,000, right? And then in the third year, Tesla goes up to $30,000. Now notice how in both scenarios, you're basically, your net gains at the end is the same. Whereas in the no tax loss harvesting, you have a cost basis of 10K and gains of, cost basis of 20K and gains of 10K, right? So your basic gains are still 10K, whereas in the tax loss harvesting side, you have $14,000 cost basis, gains of $10,000, gains of $16,000 and losses of $6,000. So your net gains again are still 10,000, except in the tax loss harvesting case, right? You have $6,000 in losses that you have collected early on by year two. Does that make sense?
Yes. So they've taken. So the thing is, how do people learn about this, right? So do you have? So until Frec came out, theoretically, you had to be with a wealth manager and have a certain amount of money because of the cost of doing all this, correct?
Yeah, totally. You had to have, at least $1 million. You had to, in a way, like, understand this concept really well, or maybe even just delegate that to your wealth manager and be like, okay, you know what you're doing, so just do this for me. And you would have paid like maybe an amount of money for it that didn't really make much sense. So what happened is Frec came along and said, okay, well, we're going to now make this available to everyone with very low minimums and very low fees, such that it's a no-brainer. So it makes sense to replace an ETF for you, right? I was going to make one point, which is, this is basically, there's some interesting stats on this, right? Let's say you invest, let's call it, just to make the numbers round and nice, let's say you have $100,000 to invest, right? You can expect to generate up to 40% of an investment back in capital losses with direct indexing. So $100,000 investment, you can make $40,000 back in capital losses, right? Whereas if you put it in an ETF, you don't make any capital loss, especially if you have a buy and hold type of long-term sort of outlook on it, right? So that 40% number is really important. And then the other thing that's really cool about it is the losses are front-loaded. So you collect them in the first few years, right? And the key is to use these losses against other gains. Let me just very quickly overlay the way capital direct indexing works on the same chart that we looked at, right? So you've go back to the mutual fund and the ETF, right? And now, so what does direct indexing look like? Well, direct indexing looks like this, where you basically have a NAV, and your net asset value is going to track very closely the way the NAV of the ETF, right? There's a tiny bit of tracking error, but it's really minimal. You're going to have the same number of shares as you would with an ETF. But what you see on the bottom is now you're starting to collect capital losses, right? So you have losses that you start to accrue in year 1, year 2, year 3, year 4 until the end, right? Now, if you sell your direct index, you basically use these losses against the extra gains that you've got. But so what's the point, right? If it's zero sum, what's the point? Well, the point is like in the very, very, very early years, as you're collecting losses, you need to use the losses against some other source of gains. Like let's say you have concentrated stocks that you're trying to sell out, and you're worried about the tax bill. Well, you now can use the losses that you generated to offset those gains, right? Or you can use the losses to offset gains from real estate. You can use the offset an angel investment that goes public and so on, right? So think of it as a shield against future capital gains, right? You use your direct index to accumulate capital losses, which, by the way, they carry forward forever, right? They don't expire, right? And there's no limit to how much you can offset in capital gains. There's a misconception that, there's a 3,000 limit as to how much I can offset. Well, that's not true. You can offset an unlimited amount of capital gains from your losses. Now, if you don't have capital gains to offset 1 year, then you're limited to $3,000 of ordinary income. But it's really unlimited. If you have accumulated $400,000 in losses and you have a $400,000 gain, you can offset them completely and not pay that.
Yeah. Now, who tracks that? Does Frec track that? So you've got, you invest, let's say, $500,000 for 10 years. First 2 years, Frec tells you got 20 grand in capital losses. Now, how does the customer track that?
Yeah. So it's all on the Frec dashboard. So it would show you exactly how much you've harvested.
So that's the beauty of this. Like, it's tracking and you hand it over to your accountant and boom. I think for you, Josh, with Ritholtz Wealth, they do probably use through Canvas and they're doing that direct. But this is for anybody at home, just like you opened up a Robinhood account, over the last 10 years. You open up a Frec account, you can get T-bills at 5% while you're debating whether you want to invest in direct index, and you go into XLK. You can also kind of remove and add stocks and SPYs to kind of build your own index if there's a certain company that you own too much of because you work for the company, and then Frec kind of manages that for you. So maybe quick shot of the dashboard here.
Yeah, I can quickly show you what a direct index account looks like. So this is an actual funded demo account that we've got, and
but not mine. This isn't mine. Mine's worth way more.
This
might be the founders. So
the way this works is you when you place a deposit into a direct index. So this is the info tech, right? So this is just the S&P 500 information technology. So it's a 65 tech heavy index of the S&P 500, Microsoft, Apple, Nvidia, etc. And this investment was made in August. And you can hover your mouse at any point in time, and it would tell you the value of your direct index. And it would also compare it to what if you had bought the ETF instead. So in this case, it bought $1 million worth of the S&P Infotech. And it's now, the index is up 23%, so it's tracking it very closely. And you can tell on the left-hand side over there that, there's a bit of tracking error. So you're at 1.234, whereas the XLK is at 1.219, right? So you're already doing a bit better than the XLK. Also, it has harvested $27,000 in losses, right? And you can see exactly what it's doing. You can, every day, like this was, 5 days ago, it harvested $200, it sold a bunch of stocks, bought some other stocks, right? And so it's constantly doing that every day, looking for opportunities, looking for tax loss to sell and other tax loss to buy to do two things. A, keep you super close to the index, so minimize tracking error, and maximize the amount of losses that you've harvested. And so it estimated that.
This is pretty genius. I mean, Phil, this got it. Like, it takes your idea of what you do and just blows it up. I mean, again, this is all like, this is going to take a long time for people to grasp the tax advantages. You know, you got to teach people direct it. You got to say the word a million times for people to get it, and then they got to be able to get it, which they can at Frec. I mean, Phil, is this something that like you who indexes it with Vanguard? What is it? How does it change the way you think about it?
It's just it's making the difficult simple, and that for me is the alpha. That for me is the value. And so that's what I'm looking for. I had one other comment too. From an entrepreneurial point of view, this is something I love. So you did Twitvid, and they were either going to shut you down or they're going to have to buy you, right? And so they bought you. And from this, you know, from the entrepreneur's point of view, the thing I love about this, and whether it was intentional or not, is that this is such an obvious bolt-on for a Vanguard is a gargantuan giant player. And I just keep it really stupid simple with, you know, basically 4 Vanguard ETFs. It's like pretty much, you know, that, and then there's cash. Like that's pretty much my own whole portfolio. A little bit here and there, playing around with Google and FXI or whatever, but for the most part, and having an overlay like this. So from an entrepreneur, I just want to congratulate you. And I know you have a slog ahead of you and it's hard, but I just want to, just that mind, because any large any ETF company has to be thinking about you, has to be thinking about what you're doing right now. And this is, you know, I mean, Canvas is whatever it is, and that aside, they've already been taken. But you're just putting yourself in a spot yet again where I just love that. I just want to congratulate you on that. You know, it's just this idea of.
I thought you would love this.
I love the making difficult simple, because I could never think through this stuff. I mean, I have this conversation every year with my accountant. You know what I mean? And it's like, we have the same conversation in fact, we're just about to have it again. It's March right now. We're going to have this conversation in the next month.
Just invite Mo.
And
I know,
just
but
invite
it's
Mo and JC to that combo.
It's part of like an overall portfolio and lifestyle, to Perlman's point, right? Like I have all kinds of different investments. Obviously I'm trading, we're shorting Apple, we're doing this, and then that's one part of the portfolio. And then we have another part of the portfolio that is essentially doing this indexing and tax loss harvesting. And then I have other strategies where Sean is selling strangles for me every single morning, right? So like there's a variety of different strategies, which I absolutely love. I am convinced there's white papers. My friend Chris Kane he wrote a white paper about it in terms of diversification, the sweet spot of having 4 to 5 strategies that are uncorrelated with one another is real diversification. And I truly appreciate that. And this is 100% one of the sleeves sort of in my strategy and lifestyle. No question.
And there's other backstory of the company we'll have him on again. But like the main point I want to have him on is this is Trends with Friends. We love talking about markets. Mo would love talking about markets, but he hacked away. And again, you can't imagine the technology on the back end because he's built on top of Apex, and which Robinhood was built on. And it's not the most modern technology, right? So you have to be an engineer. We're not in the age of AI because this is some truly ridiculous complexity being hidden because he's working on a very complex back end that's somewhat archaic in Apex. And so this is not something you can just go bang out. So this is something that was so complex. The retail usually sees this stuff, or individuals as we call ourselves, usually sees this stuff 10 years after the pros have it. We're in real time. My daughter with 50K can do this. This allows her to learn the best things about the market, which there is a hack in the system. The tax loss harvest is a hack. And if you're not taking advantage of hacks that machines will do for you, our job on Trends with Friends, we talk about trading, we talk about the markets. If you're not taking advantage of this type of hack first, you're just not being smart. Now, JC's doing that with his wealth manager. Everybody can do this by quickly opening an account. And we're talking about the S&P, nothing fancy, and the XLK, which has outperformed the QQQ. It doesn't have Google in it. And right now that's a good thing because it doesn't have the woke Google in the XLK ticker. But the other thing we're doing at Social Leverage, we're friends with the Van Eck people. The SMH is probably going to be one of the most interesting buy the dip phenomenons over the next 20 years as it competes with QQQ. So there's so much more opportunity for products to come on to this because the technology is always built. I think the genius hack here, Mo, too, is just the UI. Making people feel comfortable that they see their tax loss harvesting in real time. And I think it also will overcome for guys like me the mentality of, am I buying too high? It's almost like I can't wait to get started because if the market drops 10% and I'm in this thing for 20 years, I'm ultimately already ahead a couple points because of the tax loss harvesting. Am I wrong in thinking
totally.
about that mental hack?
There's a psychological element to it, which is, I'm going to put in money. I'm not going to try to time the market because it's almost impossible to time the market. If the market does well, great. I'm not going to lose anything. I'm still tracking the index. If the market dips, well, I'm going to take advantage, right, of the tax loss harvesting that happens on a daily basis, which doesn't happen. If you buy an ETF and you just happen to buy it right before a big dip, you're just kind of buying whole.
Well, what about, and then does it, like, I love the Perlman, is it the 8% rule? For me, it's 8%. Like, if you're putting money away every month, if the S&P is down 8% in a month, you put twice as much. Is that the number, Perlman? 8?
Yeah. I mean, I do it by
10.
I do it by vibe, but 5 to 10%, and also a little seasonality.
When you look at that compound interest,
vibe.
When you do that, the compound interest, the whip at the end is just crazier whip at the end. Like, it's wild. It's fascinating.
Yeah, it's beautiful.
That is the new tagline, please. Phil Perlman has an affiliate Lego. I do it by
vibe. You know what? Actually, I love something Howard said. Howard, you could bust me, but I'm going to love you now. I love what you said about Rachel. Like, your daughter, showing this to your daughter, it just made me want to show it to my kids, who are younger than Rachel, but they started investing their own money. They started working in the summers and then putting that money into QQQ and VTI. And they're going to get this immediately. They're going to understand this in like 2 weeks better than I understand it now. Because I love that. So then they're going to have that built into their head.
Yeah, but your father wasn't Phil Perlman, though.
Right. Well, that's exactly right. I mean, we're taking some inefficiencies out of the market with every generation. First it was, mutual funds, then ETFs, and now being able to do this is beautiful.
And so this ties into the biggest trend of all, which is AI. And I think, Mo, we want to switch to talking tech, unless we miss some things we'll have you back, but unless we miss some key things.
No, we've got more.
Okay. So what's the biggest trend? AI. Mo does not do press. This product sells itself.
Are we press?
We're not.
Are we that?
We are vibe press. We are pressed with a vibe.
A vibe session.
So just to unlock this a little further, because there's two things that have to happen. First things first is the skeptics. They're going to say, "Oh, this is for rich people. They worked at Facebook. They have 90% of their net worth in Facebook." Explain the bad marketing or the misconception about that, Mo.
Well, no, everyone benefits from this, right? Because it's sort of like using a credit card. I like to use that example, right? When you use a credit card, you're collecting the credit card points, right? And you use these. It's a reward system for when you're spending, right? And this is a reward system for investing. Like, if you're a passive investor, you should be collecting these capital losses, right? Accumulate them because you never know what's going to happen in the future. They don't expire. 20 years down the line, you sell a home for a big gain. Well, you're going to have to carry forward a bunch of losses that you can use to offset, right? Gains. That's how rich people think. They are developing a shield against capital gains taxes, and everyone can take advantage of that.
So here's what he's built. Direct indexing is like we talk about AI here. JC as a master of CMT, how money market flows. AI helps JC because it helps him do his job faster. And it helps surface ideas, right? As you type, other ideas may come to you based on what you've typed before. For what Jensen Hang was, however you pronounce his name, was just saying, and I just can't believe how eloquent. It's not salesy the way he talks about AI. It's just, I was here. No one believed me. This is what we thought computers should be like. Meaning, allow the people with domain experience that don't necessarily have tech domain experience, have the people with domain experience, and what do we have? Financial domain experience. Have those products be built that allows people that have the domain experience to do the right things and play at the level of a master. And taking advantage of the tax laws here and the idea of compounding is about as, ETFs are a great leap. They're not a bad product. But if you are going to do ETFs and you have that type of time frame, this is a no-brainer. So that's kind of what's cool about tech and, this hack of the tax loss harvesting. What's the most exciting thing with you, Mo, in tech right now? Like, you're a geek, so where's AI have your head thinking?
It's fascinating. Look, there's so much. The big buzz word today is around Gen AI, but really, AI as a machine learning in general is applicable to all kinds of spots, right? Like, we are going to use it as well when it comes to time. We're already using it in terms of how do you like reduce tracking error even more, and how can you teach the machine to make better decisions on what to harvest and when to harvest, and the short-term gain is about to become long-term gain in a few more months or a few more weeks. Is it better to wait, or is it better to actually harvest now? Do you harvest that when it's not? There's like so much potential, and any company that's...
And the beauty is you're doing that behind the scene. Vanguard knows this is a good product, but hasn't offered it to Phil yet in a way that, whether it's a notification or an alert, and say, Phil, by the way, we have an airline frequent flyer mileage. It's called Direct Index for this exact same DTF that you have. It's shocking to me that doesn't I can't explain it. They're not trying to screw you, Phil. There's got to be reasons.
They're incompetent, and that is not their expertise. No. I mean, just go to their website. Like, no, just from a product point of view, they're going to need you so badly that it's a joke. I mean, at some level, I'm sure you're aware of this. You're a humble guy. You're beautiful. But I'm sure at some point, in some level, you know this. Like, you probably pull up their website, look at it for 5 minutes, and you're just like, oh my God, like the same way you were doing.
No, but for certain large clients, they'll offer this. Everybody has some form of direct index. So Mo, talk to that for a second. If you're rich, what are people at Goldman Sachs or we talked about Canvas, which is the O'Shaughnessy family. The company was purchased. It was a little more complex technologically. It was more of a Salesforce meets direct indexing. You're hiding the complexity. So if you've got 10 million at Goldman, they're offering you a product from Parametric, right? They're offering a direct indexing solution. It's just you're paying the 60 basis points to be with the financial advisor. So let's talk about that too. Like, you can get this done, but it is going to cost more.
Yeah, it's right now gate capped behind. You have to have an advisor. You have to pay a lot in fees. And frankly, it may not actually make a lot of sense to use direct indexing if you're paying so much for it, because your portfolio is compounding, right? So you're paying, imagine, I'm going to just share one slide.
Yeah, this is an important one.
The point behind the fees. It's basically there's at some point, look, this graph, what is shown is the difference between an ETF and direct indexing, right? And it goes positive and negative on the y-axis, right? So at high fees, like if you're paying 0.75, which is basically you have an advisor who's throwing you into like a parametric strategy or something like that, and you're not paying like 0.75, for example. At some point down the line, between years 10 and 13, right, you would have been better off just buying an ETF. Because at those fees, like you're eating 0.75% a year into a compounding and a growing portfolio, and the tax benefits are front-loaded at the beginning, right, with the direct index. So you're not really accruing.
Super interesting. This is an important point. You're being honest about this. There was a certain point where this math wouldn't work.
Well, the truth is, we think the only way to build a company is if the customer benefits in the long term from us quite a bit. What happens with a lot of these clients who use direct indexing at high fees is at year 10, they exit direct indexing and they're like, oh, well, I want to leave the strategy now. I've collected all the benefits. How do I and now they're stuck with like hundreds of stocks because it's not as convenient as moving like one ETF. Whereas if you choose a provider with more reasonable fee structure, such that it makes sense long term, like a 0.1 or a 0.25 fee structure, right? Those are reasonable prices. then it makes sense for you, right? So I think that's important. I think a lot of these other firms are more short-sighted. They're going to charge the big fees. The clients are going to pay the fees. And then at some point down the line, those tax laws would have aged a lot. And so they're not doing much, right? They've escaped their cost basis by quite a bit. And so they're not doing anything. They're not harvesting losses.
So you're thinking about where we're heading, not where we've been.
Yeah. Well, so where we're heading, the next thing is you got my daughter as a customer now because she understands direct index. You have my wife, you have me, you probably get some of Phil. JC is direct indexing in his own way. Is there a problem with the term? Like, what if you could wave a marketing wand because you're out there trying to raise awareness? Well, how low is the awareness of something like this?
Yeah, because Howard, this is like what you say about technical analysis. It's a terrible name for something. A direct indexing might be in that same category.
It's like Satoshis. Like engineers develop crypto and they have their own inside information. I don't even know what Discord is to talk about crypto. They got a scam going on us forever. So this is a very simple hack. How do we, as human beings, speed this up? It took 20 years of mutual funds. We used to look them up in the newspaper. Then ETFs came along. I don't even think people know the benefits of ETFs. They just because everybody's doing it. So what are the little, because the world of ZERP is over. The world of free customer acquisition is over. The world of you living in a Twitvid inside Twitter with 60 reorgs, that fantasy world does not truly exist anymore because Elon.
Hey Mo, how bad is it over there?
Everybody's copying it.
I mean, it's been a poor organization for a long time since the beginning. But what's your vibe there now? Like, how bad is it really?
I left the company too long. We left way before Elon came along, so early 21. Yeah. So I wouldn't know.
But it was on its way to early Gemini status. They were Gemini before Gemini. So what is next? What is the next thing that Uber was like? The idea you could be a rock star. Robinhood was like you could trade like a freak. Direct indexing is you can chill like a billionaire, right? Like invest like a billionaire would, right? And it is, people want a YOLO. They're going to do that if they're not rich. But, with 50 grand, you can start, right? And this starts you on the path ahead. What's the next product for that aspiring? And what is there a product inside Frec that you want to build, or if the market changes, it's the next thing that people want?
Yeah, that's a good question. There's a lot we can do. So there's a new technology that is being talked about a lot, or a strategy, I should say. Long-short direct indexing. Right? So you could take the tax loss harvesting that happens and you can boost it. You can almost double or triple it. So if you go, for example, 150 long, 50 short, so you're still market neutral 100%.
Now JC's got a little bit of a direct indexing chubby. We call that. DIC, direct indexing.
I get
chubby.
it. It's great. I'm in. Honestly.
No, so 150. So So for so you're saying press the tax gain, basically.
Yeah, you literally, instead of harvesting that 400,000 or 40,000 and 100K, you harvest 80,000 now. So what does that open up? If you have a concentrated stock position, we talk to customers who are super early at Google. They have $10 million in Google stock at like literally zero cost basis. And they're like, I want to get out of this, but I don't want to pay the huge tax bill. They live in California, right? So what you do is you sell it and you put it in a long-short direct index, right? So you generate almost $8 million in capital losses and you barely pay taxes. And it's all perfectly legal. It's just doing both long and short, right? So when the market moves up, there's tax loss harvesting opportunities, and as well as when the market moves down. So it's a really cool AQR paper on this called Dynamic Direct Indexing, and talks about it in detail.
So theoretically, I'm not, because I've sold my hood other than for a small amount. So theoretically, tell me if I'm wrong. Stock's at 20. I feel like I don't want to pay the taxes on something like that. I could, even though Robinhood's not in an index, I could have theoretically pulled. It probably would have worked in my huge favor because Robinhood went down on top of it. But like, I could have done that even though it's not directly in the index. Yeah,
you basically what you do is you sell at the beginning of the year, right? You want to sell in January, February, something like that. And then you have the rest, and then you put it in a direct index, and you have the rest of the year to harvest losses, right? In that index. So as the market moves up or down, you're harvesting losses, and you're offsetting that tax bill when it comes due the following April.
Yep. Well, learned a lot. JC, let's get back to the real world. I want you to listen in a little bit, Mo. JC, I mean, this is a party. So, JC, let's catch people up on what is happening. I think, the market looked a little bit toppy. You were out here, we're talking about breadth. I didn't react to anything. Obviously, I'm not active that much. But man, biotechs, financials, everything seems to, dude, there's a couple charts that I show you on crypto. What is happening in crypto right now pales. It's blowing away what happened in crypto in 2021.
Let's get into it. So I think here's the story.
Get into it here.
Yeah. So here's the story. So throw up the first chart. This is really it. I think it's important for investors to understand what's inside these indexes. When you talk about, the stock market, how the market do, what's exactly in these indexes? Should we be in small caps? Should we be in large caps? Well, what's driving small caps and large caps? As it turns out, it's the same thing that's driving the difference between an equally weighted index and the market cap weighted index. It's the difference between what's driving value versus growth, what's driving industrials versus the NASDAQ. It's exposure to technology. The rest of the country doesn't have, the rest of the world doesn't have massive technology exposure. Small caps don't have massive technology exposure. The equally weighted index, by definition, is equally weighted. So it's not going to have all that aggressive growth exposure. Same thing between the Dow and the NASDAQ. Very, very different. So when you're talking about these things, I think it really comes down to understanding what's in the sector. Go down and look at Apple, which is a market bellwether, making new 3-month lows literally today. As we speak, Apple making new 3-month lows. So if Apple's breaking down, not only is technology going to continue to have a hard time going up, but I think it's going to drag the indexes with it because the S&P 500 is 30% tech. The NASDAQ is 50% tech, right? And Apple's obviously a huge component of that. So it's about breaking it down, and you can continue. Look at the equally weighted NASDAQ 100. Just now, finally getting back to those former highs. So it eliminates any thoughts of the Mag 7 or anything like that. This is simply an equally weighted version of the NASDAQ 100, just now getting back to those highs from late 2021. So the way I like to look at it is, well, how's the market going to react now that we're back up here? And what I like to do is I like to look at the components and the other types of companies that look exactly like that. And Google is that. And Google is rolling over at those former highs as well. The strength, I think, scroll down 2 charts, the strength, I think, continues to come from energy, and nobody's positioned for it. There's huge leverage in U.S. equities, particularly tied to technology. And while this might not change longer-term trends, which I'm in the camp that this is a longer-term bull market that we're in the middle innings of, and I still think that there's upside, in the short term, I think that there is continued vulnerability in the equities market. How many people are positioned for crude oil to dramatically outperform the S&P 500? Is that why interest rates are making new multi-month highs, right? So I think the pain trade could very well be higher oil, higher commodities, and lower stocks. And you could scroll up, and the winners so far since the fourth quarter of last year when we bottomed has not come from the energy stocks, with few exceptions. Some of the refiners are doing well, of course. It's come from the commodity, crude oil, gasoline, heating oil. You're seeing it from the commodity itself. So I continue to think that this is a market where having the United States as a short position against other longs. I know Perlman's been talking about China. We've been talking about China. I think energy's one of those possibilities. But if you scroll down to the last one, this to me, I think is another big one. So this is the S&P 500 in the United States, obviously, relative to EFA, which is developed markets outside of North America. So anything outside of US and Canada. So this is the ratio between the two, is now back at those former highs from the end of 20, right? We're back at those former highs. So look at the difference in composition. The S&P 500 is 30% tech. It's actually more than that, but it's like 30.5% tech, 8% industrials only, and only 2% materials. EFA is a third of the tech exposure, less than a third of the tech exposure, double the exposure to industrials, right? And three and a half times the exposure to materials. So much different weighting in these other countries. Look at Japan, UK, a lot of Europe in there, of course, Australia. Those are the developed markets outside of North America that are ex-tech. So I think what could be dragging the United States down, the lack of that exposure, in my opinion, we'll continue to see the relative strength from some of those areas. We'll let the market prove those trends wrong, but that trend, in my opinion, currently is still in place. And Apple making new 3-month lows today just reiterates that trade. Doesn't mean it's the end of the world. It doesn't mean there's this AI bubble that's popping or this or that. It's just rotation in the middle parts of a bull market where some sectors get messy. And it just so happens this is America's biggest sector by a long shot.
I have a question for you, JC, about this. So there's something called the home country bias, where investors have this tendency to invest in their home country and neglect foreign markets. And, smart people would say, behavioral economists would say this is a mistake for the long-term investor. And so I'm looking at that chart right now, and I have definitely been guilty of, and I'm aware of all this stuff, but I've definitely been guilty of the home country bias. I am long, the VOO and VTI and QQQ. And I
but
just
yours is not a home country bias. It's a recency bias. It's not home country.
No. Oh, okay. Part of the home country bias is a recency bias. In my case, there's no question about it.
The home country bias. Your home country bias is as a result of your recency bias.
No question about it. Maybe so. That may be so. You may be right about that.
But Phil,
one more. But here's my question. I just want to ask the question really quickly. So now I'm looking at this chart, and there's been other times when we've been up here. And it seems to me that now would be the time for me to do a little repositioning and taking some of that American bias and spreading it out into like an IFA-based ETF. Would you say that this would be like, hey, if you've been biased, you've benefited from it accidentally, now would be the time to do that?
Here's what I'll tell you, and I don't want to be a cop-out, but it really depends on who you are and what you're trying to accomplish. I think what you're describing is one very excellent way to think about it, no question. But let's say as an investor, you don't even want to go there. You don't even want to leave the United States. Just understanding the rotation among different sectors and strength in different types of companies, that alone puts you so far ahead of everybody else, right? Like what you're saying, yeah, you're not wrong, but there's a lot of different ways to think about it. For me, it's more just a function of, watching the sectors rotating and the fact that if money is rotating into energy stocks and 2% of the S&P 500 is energy and 0% of the NASDAQ 100 is energy and money's rotating into energy stocks, well, if I own the S&P and the NASDAQ, that's not really a good situation, especially if it's rotating out of technology, which obviously it has been for most of the year. So as we continue to see that for a lot of investors, especially investors with home country bias plus recency bias because of all the success over the last decade and change, many people are very exposed to a correction in technology that, by the way, started at this exact same level 2.5 years ago or so, whatever, 2 years ago? End of 22?
Exactly.
End of 21?
I will chime in to say, that I talked about before. If you're investing in startups, man, once you start getting away from your home country bias, you got to start talking about currency risk. And I think the fact that you own the indexes you own, really, they're not home country, right? Apple's, they're all thinking through Vietnam manufacturing. Where are these countries? Their taxes are in Ireland. You're not really a home country.
Yeah, well, there's this other stat as well, Howard. Like 40% of the revenue of S&P 500 companies is international. It's outside of the US. You have some.
I think correct. So what JC's saying is very interesting because industrials, right? Like there's 3 major things going to be happening around tech right now. I don't know if the New York Times case is huge. Who owns the content? Should the comics and the writers have their stuff whipped up into an LLM and misused and not appropriated? At least a Google link gave them attribution. So that's a major technological meets media meets cultural war that is just beginning. The second one is, will Europe, which is a mess, there's nobody that would argue in their right mind other than, from the prices, which are going up, which is fine. Stock prices are going up, which is wonderful. It doesn't mean I have to go there and live there to participate. But everything under the surface is like, we can't have another Google and Facebook with AI, right? Like, we can't let them win again. Look what it's ravaged our tax system in our countries before. So you got that, everybody looking inward, including the US. So, I mean, to me, this is a perfect time for a rug pull, right? Like, the cynic in me is like, banks are doing well, genetics are working, crypto is acting like it's a party, Apple's rolling over, NVIDIA can do no wrong,
Crypto
JP
punks,
Morgan
new
is
52-week highs for the
highs.
crypto punks.
Not just crypto punks. Pull up a chart. I got to show you one chart.
I got it.
I'm a lucky well, the crypto punks I'm not in. I'm a lucky investor in this ETH.5. I don't even understand what Ether is, but I've allocated money to, as you know, to crypto. The craziest chart I've ever seen, because while everybody's talking about their 3-bagger in NVIDIA, there's 20 baggers and 30 baggers happening overnight in the crypto space right now. And I think it's just this massive, this goes to the degenerate economy. You know how I mean it like that. But this degenerate economy is learning, right? They're getting smarter, right? Eventually they're going to discover that for their serious money, taxes do matter, and they're going to go to direct index. But for everything else, stocks are boring. This is, I don't know, DeFi Llama. I mean, these are real things. This isn't like a $50 million penny stock. This is a liquid $1.8 billion token. And with stablecoins exploding, these gains can be moved around now. But this is I'm not even going to get into what it is, but that's not fake. That thing has gone from 100 million in January 24 to 1.7 billion today. They just raised money at a 240 million, probably from Andreessen. I'm a lucky investor in the seed round. I have no way to get out. I'm just saying, how can I talk to, when this is available to everybody, 24/7, 365, and you learn this stuff before the next person, it's going to be, we are in for this wild new world of degeneracy where it's being played, Phil, on levels that we used to call the bulletin boards. These things are distributed globally. What we thought was like being in the know is the exact opposite at this point. Do you mess around? I mean, you as a tech guy, do you mess around in any of this stuff still, like just because of the technology, Mo, or is it just something that I just surprised you with and it's foreign to you?
No, I don't touch it.
Yep. Yeah. So that's what's going on.
Degeneracy 2.0, bro. Because we already had this, right? This is coming back now with the animal spirits in crypto. Now you're getting the higher beta stuff is starting to really come back and go.
No, but I think what people forgot, and this is something for Mo and Frec to think about, stablecoins are a form. Again, it's not for me yet because I'm 58. But if you're 28 and not understanding what stablecoins are and having your wallet to play games on Solana or Sui or Aptos, I think you're doing yourself a disservice, right? Like, you are now falling way too far behind with your money, and what's happening to gold. As we're seeing, this has been a perfect environment for gold for the last 10 years, and it's gone nowhere, right? Because there's too many choices for people. And the one use case of gold, say I got to flee my home, is actually better used by crypto at some point. So saying while you were, relying on the old textbook, a new textbook comes along. So I think it's hard for me to to explain how behind I feel, even though I feel far ahead when you see stuff like this going on in the market. And it's not happening in the public market. It's not happening in the venture market. It's happening in a liquid form of venture, which is just, is mind-boggling. So, there's a lot of stuff to unpack over the next 6-7 months, but that was Mo. It was great to have you. Frec is, very cool. FREC.com. It's pretty easy to set up an appointment and get one of your one of the advisors to kind of help people walk them through, right?
Yeah, no, totally. Yeah, it's.
What are you seeing? Generally, it's about 10 minutes to set up. What's the setup time?
It takes a couple of minutes to onboard, and then it's a quick. You can transfer stocks in or connect your bank account and fund an account. It's very quick.
Yep. And so there you have it, Phil. This is the kind of stuff Phil loves. Like he likes to be surprised and just talk about
great stuff. And I love the interface. Yeah. I love just the simple interface. And great. Best of luck to you. I think you're going to get taken. I mean, I think it's inevitable. But best of luck to you, brother.
Thank you.
He's well capitalized. We have raised a large venture round, so it's not like that's in the plan.
It's beautiful because he's a product guy, and the big players need the user experience is terrible, even though they have more money than God, and they need that so bad, and they need the functionality too, because you're forcing the service downstream. You're forcing the long tail. You're saying this is for everybody. I love that too. So I just, I love it. And I loved hearing it from you. Howard tells me about this stuff and I'm just like, oh yeah, okay. That sounds really cool. But hearing it from you is like beautiful.
Thank you.
What's your quick tip for staying lean and mean?
Okay, so here's the thing. I have a thing. So I love this. I love flipping things upside down on people, right? So one thing that I notice is that on the weekends, a lot of people deplete themselves, right? So they get to the weekend, they're like, oh, I just ran a marathon all week. I worked so hard. And now it's the weekend. And what do? They party. They get out of their sleep pattern. They eat garbage food. And then Monday morning comes and they're tired already. And then they have to go through this long week again. And so I notice that all the time with people out there, with clients, the whole thing. And so what I'm going to say is, and this is not a religious thing. I'm not a religious guy. I'm a spiritual guy, not a religious guy. It's not a religious thing. But I'm saying over the weekend is a great time to take the minutes that you have and to just get yourself together, to get outside, get in nature, go for a long walk, spend time with your people, rest, go to bed early. What a contrarian play to go to bed early on a Saturday night. Eat healthy food, maybe go for a run, maybe get a schwitz and get a sweat going. So that is a beautiful thing where you could take something that's a negative in your life if you're stressed and tired and overworked, and you could turn it upside down and make the weekend time a time for nourishing yourself and replenishing yourself rather than draining yourself. Flip that for real.
Beautiful. I'll let you end it there. Mo, any tricks you do to stay lean and motivated?
Yeah, it's certainly like I've got 2 kids, and I love spending time with them. So life at this stage for me is basically work and kids, and there's nothing else. And when I'm stressed out, even playing a game with them is a fantastic way to just disconnect.
Beautiful.
How's San Francisco? Is it bouncing back?
San Francisco is actually, there's a ton more energy now. There's a lot of events, a lot of founders, a lot of folks moving back, and there's still some crime on the streets, but it's getting better. Like it's certainly, you can feel like it's getting better.
I gotta say, I think you may be the closest looking. You may look more like Phil than I look.
Well, it's the haircut,
Handsome guy.
All right, kids. JC had a run. We're gonna run. We just, I really enjoyed it, Mo.
Thanks for having me. This was an awesome
educating us.
Yeah.
And then to everybody at Trends with Friends, we will see you next week.
Thank you.
Pleasure, Mel. Cheers.